My name is Natalia Reizel, and I'm an associate professor of finance. And today I would like to talk about my paper that analyzes debt security design, and it is related to hedge fund activism. Hedge funds seems to increase shareholder value, at least in the short run. One important concern, however, that such activism may destroy debt value. Hedge funds often push companies towards increasing leverage, increasing dividend payouts, or selling assets, and such actions are known to harm debt holders. So, as a result, banks and other investors may be reluctant to provide affordable debt financing to companies likely to be subject to hedge fund activism. So in this paper, my co-author and I investigate how companies design contracts or securities to protect debt holders and ensure debt financing in the era of hedge fund activism. So we looked at innovation in debt contracts called dead hand proxy puts. This provision triggers default and immediate repayment of corporate debt if there is changeover in the board of directors related to proxy fight. We linked this provision to hedge fund activism and showed that it can protect debt holders. To analyze this provision, we performed cumbersome data collection. We collected data on loan characteristics, bond characteristics, debt prices, equity prices, firm financials, and actual interventions by hedge funds. This procedure resulted in a sample of more than 53,000 loans, covering about 7,700 companies. We found that dead hand appears in loan contracts of companies likely to be subject to hedge fund activism. Very interestingly, while this provision protects debt holders, it also makes it more difficult for hedge funds to succeed in their campaign against the company and its managers. And the result, managers may use this dead hand to deter hedge fund activism at the expense of shareholders. In other words, managers may use dead hand to protect their jobs and avoid being fired in case hedge funds succeed in their campaign. Contrary to this concern, however, we find no systematic evidence that dead hand harms shareholders. It seems to allow companies to secure low-cost debt financing in the era of hedge fund activism, in this way benefiting shareholders. There are some exceptions, however. In a subset of companies with large free cash flows that are not paid, we found managers use dead hand to benefit themselves without providing any additional value to shareholders. We also look at bonds and found that dead hand appears very rarely in bond contracts. However, we find that bondholders react positively to dead hand that appears in loan contracts, suggesting some spillover benefits to the bondholders from the protection that dead hand offers to bank lenders. Overall, our analysis provides insights how companies design contracts or securities to secure financing.